So if I'm a business seller considering a solar project, and we have these conversations in development stage, construction stage, and post operational stage all the time, you're evaluating, I coined it the matrix years ago when I was at SunPower. If you think about, there's two key financing decisions you're really trying to talk about. One is, where is the money coming from? And then two, where is tax credit monetization coming from? So if you think of it as a 2x2 matrix with capital access on one, do you need the money or not? Do you already have it budgeted? Do you have internal cash, or do you need to procure the money? And the other axis being, do you have tax liability or not? So if you've got the money and the tax liability, you're a traditional cash buyer. If you have the money but not the tax liability, this is where we would say, hey, this is a great opportunity. You pay cash and sell the tax credit, or borrow on your credit line and sell the tax credit. If you've got tax liability but not capital, then that's a loan. You can borrow the money and then monetize the tax credit, or a scenario where you're looking for both.
Welcome back to Renewable Rides. Today's episode is about one of the most misunderstood levers in on-site energy right now, tax credits, and more specifically, tax credit sales and transfers. If you're building a solar or battery energy storage project and you want to turn tax credits into cash, the rules are simple on paper, but execution is not. Today I'm joined by Erik Underwood, co-founder and CEO of Basis Climate, and James Coombes, VP of Business Development at Conductor Solar. Together, they sit right at the intersection of clean energy finance, underwriting, and the rapidly evolving marketplace for tax credits. My co-host Gareth is a bit under the weather today, and I wish him a speedy recovery. So in my conversation with Erik and James, we cover tax credit transfer 101, including what credits typically sell for and why timing and IRS registration can make or break a deal, how small credit transactions differ from utility scale, and why insurance often does not pencil for smaller deals, what sellers need to have ready, from cost breakdowns and placed in service proof to the diligence packages buyers expect, the real risks buyers are underwriting, including disallowances and recapture, and why indemnities and guarantees show up in so many deals, practical guidance on timing, including why you should almost always file an extension if you think you might sell credits, and a candid discussion on REITs and why many hesitate and what structures can work when a long-term hold strategy is in place. I'm confident you'll learn quite a few things from this conversation with two experts in this dynamic market. Let's jump in. Erik, James, super excited to have you on. As we do with all of our guests, would love to start out a little bit with what are you personally passionate about? Erik?
Yeah, thanks, Dan. Thanks for having me on. We're really excited to talk. Passionate about inside of work. I'm passionate about creating a successful business that helps people who don't always have the easiest path to get something done. I have always worked in clean energy, and so that's been a huge one for me. Clean energy finance, deploying projects in the U.S. and globally. And then outside of work, I would say I'm passionate about food, travel, relaxing. I like to spend active, relaxing time when I'm not working.
And James, back on the podcast with us. I was just looking back through my notes. It was just about 2 years ago in episodes about 19, 20 or so. And so remind us, what keeps you going? What are you passionate about, James?
My wife and our 3-year-old son, I keep a set of his running shoes right here behind me. Beyond that, I mean, they're great. And, we're an outdoors family. I've been in this industry now since 2008, so whatever that is, 17 to 18 years, and, infrastructure finance for a little over 30 years. And I like being able to go and see the projects that we build and finance and support. It's a lot different from doing, $1 billion plus transactions when you can actually go out and, walk some of the projects that you're building and see the guys who you're putting to work.
Yeah, love that. Well, I'm super excited to dig in today. Before we do, maybe you can spend a minute, and James, maybe I'll have you go first, telling us a little bit about your company, your role, and how did you get here?
Yeah. So Conductor Solar is a solar finance project advisory and marketplace. We advise between developers and investors, or IPPs, on putting project financing, largely power purchase agreements, but also other lease and loan structures together. That sort of positioned us organically to be in the strategic financing discussions early in the development process, and in some cases late stage and even after completion, that brought us into the tax credit transfer business. So in the early stages, clients are trying to figure out, what should I do? And then some of those go other paths. For today's purposes, we'll highlight that a lot of those clients go the tax credit transfer path, or unexpectedly decide on the tax credit transfer path after they're already contracted and building projects. So that's how we took advantage of the opportunity after the 2022 legislation to get into tax credit transfer specifically. We advise sellers of credits specifically, and that's how we interface with groups like Basis in particular.
Yeah, and Eric, I'll shift the same to you. Tell us a little bit about yourself and Basis.
Yeah, so Basis was founded in October of 2022. The joke is my co-founder and I read the IRA and ran off to Delaware to incorporate. This is really out of a context of seeing a huge unmet need in the energy finance market. Tax equity prior to the IRA was a very constrained and oligarchic market, I would say, where there was a few tax equity investors, either at the large scale and even harder to find at the small scale of tax credit volume, and they were very picky and kind of had terms that were take it or leave it. And so transferring credits and helping sellers and sponsors do that while also educating the entire corpus of American corporate taxpayers learn how to buy credits was a big open blue ocean for us. So for us, that was it's been a wild ride. It's been more than 3 years that we've been doing this. We've done over 50 transactions. We have a small but mighty team. And, it's interesting because what James was saying about them coming on pretty early on in the process, we have the fortune or misfortune sometimes of coming in quite late at the process, where most of the project has been de-risked, but you also have strong urgency from project sponsors or owners or developers to turn their projects' tax credits into cash through a transfer sale. So we work hard at always being honest about where we see the market, what we see in terms of appetite, and working with that. We're really in sort of a tech-enabled advisory space. We have a lot of standardized processes and documents, and I'm excited to talk about some of those for smaller credits on this session. But we really try to say, where can this be faster, simpler, so that we don't create an opportunity to spend 6 months negotiating a document that might only take 2 weeks or less.
Yeah, that as you know, resonates quite strong with how we see the world on getting projects to the point of wanting to transact and pursue those. So love what you guys are doing there. Well, let's, for our listeners that may or may not be familiar, Eric, can you just give us the basics of tax credit transfers? Why would a business consider selling their tax credits? When does it make sense? When doesn't it?
Yeah, so for tax credit transfers, let's start with the tax credits for any of these energy projects. The U.S. has incentivized renewable energy development through tax credits. On the transfer side, this was enabled through the IRA, where you could simply sell these without creating a partnership or sale leaseback structure with a tax liable investor who had to really get into your project or into an operating company or an asset company, as it were. So this means you could sell the tax credits from just one project. There's technically no minimum of the amount of tax credits. What the IRS did do, and what the legislation of the IRA did, was to create some good safeguards for the industry to be able to define the qualification of a tax credit. And as much as the IRS doesn't like to prescribe volume or valuation matters, they did, basically lay the groundworks for the transfer universe, following by general rules of, cost basis of investment tax credits, and or volume basis of production tax credits, similar to the last 20 or 25 years that we've seen. So if I'm a developer and I'm building, let's say, one rooftop solar project on a building, and it's, let's call it $1 million, just to keep round numbers, of solar panels. Generally, I should be able to sell those at least 30% of the cost basis, of the eligible cost basis of those credits. And so that will then let me monetize, what is $300,000 worth of credits by selling them to a buyer. However, that buyer could just spend $300,000 on taxes. So they normally would like to take that tax credit and buy it at a discount. And this is where the market can vary a lot, depending on volume, depending on timing, depending on counterparty comfort. And so generally we see, around 80 to 90 cents, and there can be a 5 to 10 cent delta on either, well, on the lower end of that, for investment tax credits. And the top end of the market, if you're doing $100 million deal, you can get, a few cents above 90 cents on ITCs in the best market conditions. And so you sell these at a discount, so that $300,000, to keep this round again, you would sell it, let's call it at a 10 cent discount, so 90 cents on the dollar per ITC, and you would get $270,000 in cash for that 10 cent discount tax credit. However, there's also transaction costs, and there's parties that are making this happen. And so sometimes you'll see, 2, 3 or more cents for the combination of lawyers and advisors or platforms such as Basis doing the transaction costs. We're always very transparent on what the estimated net proceeds are off of any transaction that we do, because we think it's really important. This is a dollars and cents transaction. Let's be upfront at the beginning on how much this should cost, and let's make sure that variable fees are capped, so that you don't have $100,000 of legal spend on a $300,000 credit. That would make no sense to anybody. And so then that's generally it. The IRS also has some really important registration points that I would say, in terms of making sure that there's no fraud in the system, because you're only allowed to sell the tax credit once. You need to sell it within the same tax filing year that the credit was generated. And you must register the credit on the IRS Clean Energy Credits and CHIPS platform. It's the same platform to register the credit, which is tied to the facility and tied to you as the initial taxpayer who owns that credit, who owns the project that generated the credit. The buyer needs to see that registration number before they file their taxes as well. So that's a really critical point, and that can take up to 4 months in current market conditions of how long it takes the IRS to provide that number. Even though it should seemingly be a simple process, there's a huge volume of credits that are being registered. And there's, sometimes it feels like an army, sometimes it feels like 2 guys in a room at the IRS processing these. So then you have a tax credit transfer agreement that is executed in there. There's a transfer election statement, and tied to the transfer election statement are your IRS registration numbers for the facility or multiple facilities if you're transferring more than one.
Excellent. James, anything you wanted to add to that overview, or should we start to dig into the details here?
So I'll highlight that how that process looks, what's required, even how deal terms and pricing look, varies significantly from the large and utility scale transactions that Erik touched on to the smaller end of the market. And so, speaking from the perspective of small credits, which without a precise definition, credits in the $200,000 or $300,000 range to definitely upwards of $1 million, $2 million range or more, they're subject to a more specific set of requirements and also limitations. So one of the things you hear a lot in these conversations is tax credit insurance. That has, at least customarily and historically up till now, been a large insurer product for larger projects that comes with upfront costs and significant policy costs. And so for smaller projects, that's typically instead of tax credit insurance, we'll see personal guarantees, parent guarantees, fundamental underwriting of the business, selling the credit, and in some cases, a letter of credit, at least as sort of a crossover or an alternative to tax credit insurance. So there's more to highlight there, but just broadly highlight that everything from underwriting, pricing, terms, types of buyers will vary significantly for smaller projects versus medium and larger size.
Nice. And I'd say most often when I hear this come up, it's from entities that don't necessarily have any tax burden or don't have enough tax burden to take advantage of the tax credits that they have. But maybe you can share with the listeners, like, why would a business that does have a tax burden consider selling their tax credits on the front end of a project?
What we normally see is there is a lot of cost related to the credits, and many of these projects are upfront costs and longer term savings, right? So oftentimes when somebody's looking at doing a single site, either as a homeowner on the rooftop, if they're buying it, this is until end of 2025, or if they're a small business that's looking to do it, they're looking for that payback period. And that payback period can be a combination of just like the energy savings that they're getting by having on-site power versus relative to the upfront cost. Similarly, if you're a project developer, you would also have, a high upfront cost for these projects, but then much smaller operating income from the revenues generated by that project. And so that plus depreciation calculations ends up meaning that normally, like, anybody can develop it. They don't have to transfer their credits to get the credit. They can hold on to them. However, and they can carry those credits forward for 22 years. However, it doesn't make sense because oftentimes it's going to be 7, 8 or more years before you actually start benefiting from that credit because of the depreciation NOL balance that you're using also as a deferred tax asset. So this is getting accounting very quick, but basically, like, your operating profit from your project or the economic benefit from that project normally will not outweigh being able to sell it at a slight discount on a net present value basis.
Yeah, so the more you can, if we treat the tax credits just like another form of cash flow in the project, the more we can recuperate all of that cash flow in year 0 or year 1, the better our net present value of the project
like
is.
A lot of people are thinking of this like, what am I out of pocket that first year, right? If it costs $1 million, boy, it would be nice for me to only have, to still have already recouped 270 or 250 in that first year. There's a working capital timing difference, of course, but like, you can see that payback really quickly. And you have the benefit of there being an urgency to get it done that first year because the buyers can't buy it after that first year.
Mm-hmm. Mm-hmm. Well, so when we're thinking about that, like if I'm a business owner and I've got, a dozen facilities and I'm considering, safe harboring these projects as we get ready to close the year, what do buyers of systems, sellers of credits have to do, or what requirements do they have to meet in order for a buyer of these credits to be interested in securing them? Because there's all kinds of nuances around recapture risk and other components of that. James, how should I, as a buyer of an energy system, potential seller of a credit, like what is the paperwork? What are the things that I need to have in place in order for it to be attractive for someone to buy these credits?
Great question. If I can answer that with a slight rewind to the question you asked before this. So if I'm a business seller considering a solar project, and we have these conversations in development stage, construction stage, and post operational stage all the time, you're evaluating. We used to I coined it the matrix years ago when I was at SunPower. If you think about, there's 2 key financing decisions you're really trying to talk about. One is, where is the money coming from? And then 2, where is tax credit monetization coming from? So if you think of it as a 2x2 matrix, and with capital access on one, do you need the money or not? Do you already have it budgeted? Do you have internal cash, or do you need to procure the money? And the other axis being, do you have tax liability or not? So if you've got the money and the tax liability, you're a traditional cash buyer. If you have the money but not the tax liability, this is where we would say, hey, this is a great opportunity. You pay cash and sell the tax credit, or borrow on your credit line and sell the tax credit. If you've got tax liability but not capital, then that's a loan. You can borrow the money and then monetize the tax credit, or a scenario where you're looking for both, not necessarily because you don't have capital. Investment grade companies certainly have capital, but you could have a lot of reasons you'd look for standalone project financing. That's a PPA or a lease project where somebody's providing the capital and monetizing the tax credit in a combined vehicle. So a lot of our projects organically start with strategic discussion on that front. And then clients will often decide, hey, look, I can potentially take the tax credit, but it's going to involve some uncertainty on my income. We deal with a lot of ag clients who have a cyclicality that's different from the cyclicality that other industries will be familiar with. And we also may need to carry it forward for a number of years. So on a present value basis, we don't have to sell it to get some value, but we could sell it to maximize value, timing, risk, and some equation there. So for clients that know that they need to monetize and a project is dependent on that, the market is now visible and liquid enough that you can give good visibility. And we do, even in advance of like bringing our clients on board, we'll do a screen to advise on sort of what's the right transaction for you. Do we want to both engage to do this? And so you go into flashing forward, you go into the tax credit sale process already sort of having a fallback on valuation if you couldn't sell it. So that's how the decision's made, at least in our corporate kind of owner user customers. There's a whole class of investors, special purpose entities that fully expect they're going to sell the tax credit. That's largely not who we deal with, but that's a relevant universe for this discussion that I think Erik deals frequently with. And then to quickly round out to the what is required question. On the front end, we always advise your contractor. You need your standard tight completion package that'll have all the warranties and diagrams and everything. And the one thing we recommend you get is a cost breakout from the contractor. It's easier to request that when they haven't been paid and punched out. So that's ready to go. You may not use that for a period of time, and there may be questions when we go for cost seg reports. We'll get to that. That's how we substantiate basis. But requesting that on the front end from your contractor, and we have a template we use that's consistent with what a lot of the major financial firms we work with require. On the back end, that question gets more complicated. So perhaps I'll answer it in summary fashion for now, which is clients should always expect an underwriting. So a profile of financials, structure, ownership, and organization. And on the project side, everything from the initial contract, utility upgrades, PTO letters, and then other documentation of placed in service. And then a collection of things that de-risk it for investors, just making sure we have warranties and that type of thing in the data room.
So let me understand a bit further. If I'm selling tax credits, let's run with the $1 million example and $300,000 of tax credits. If I'm selling $300,000 of tax credits, why would I need to go through an underwriting process if I'm selling this kind of asset that has some value?
Yeah, I'll jump in if that works. I think the U.S. has a lot of different types of experience with tax credits. And I think one of the things that makes me confident and happy to work in this industry is there's a lot of safeguards to make sure that there's no fraud here. A seller can say anything and a buyer can believe anything. And I think, for us to ensure that, there's a legitimate industry happening here that's supporting the future of clean energy, we have to make sure that there are diligent safeguards there. In addition, this has been written into the code. So there's a concept of disallowance and recapture that are, the IRS could audit any of these credits. They have details on the registration portal of all the credits that have registered for transfer. And so in any of the tax forms that the buyers have, they have to attach to their general business credit tax form these transfer election statements and the registration numbers. Behind that, there is written into the IRA, and which has stayed on with the OBBBA, a requirement for buyers to do minimum diligence to ensure that they have taken part in understanding what's there. Now, most of these buyers are just any type of corporation that isn't necessarily familiar with the energy industry, and so they're going to lean on advisors. They're going to lean on tax counsel and energy counsel to sort of look at this. And it's striking that balance the smaller and smaller you get of what is the right amount of diligence that makes everybody happy that there's a legitimate credit being transferred that has been calculated at the right level, versus not overthinking it or over diligencing it or sending fancy lawyers for a tiny project at a farm in Idaho, right? Like that wouldn't make sense. But there's a right balance there, and the market's maturing enough for us to be able to find that standardization. But the buyers do have that risk. And so that's where some of that tax insurance conversation comes back to, in terms of them saying, even if we all thought we got this right and the IRS came out and said these were disallowed, I don't expect to take, a huge hit on, unpaid taxes because the credit that I bought from you was illegitimate. And so that's where a lot of these indemnification protections come in to make sure that buyers, even if they did all the right diligence, they want effectively a risk-free credit. And, think they're taking a bet on something that they're not familiar with and on a project that they're not operating day to day. So there's a bit of sort of distance that gets resolved through that type of underwriting that we talked about.
So I've heard over the last 15 minutes, indemnification, personal guarantees, parent company guarantees. What are some of the for sellers of the credits? Are these some sticking points that, as they kind of get deeper into this thought process, that they might have some pause and say, wait a second, why am I having to agree to all these things? What have you seen in practice where some of these deals might start falling apart, or just some stumbling blocks that need to be overcome in order for this transaction to happen? James?
Yeah, so I'll note that the recapture provisions are not unique to a transfer of the credit. They apply on every system. So you have commercial customers buying solar properties all the time. You fully expect to keep it in operation for 5 years. You fully expect to own your property for 5 years. So you're not going to do anything most of the time to intentionally trigger a recapture. Or if you do, it's because a broader strategic mandate of your business, you needed to sell a property or whatever else, and it's relatively small, penalty or give back in order to do that. So with that preface, when you're selling it, what buyers are looking for are ensuring you're at least going to control all the voluntary aspects there. You're not going to disconnect your system or sell your property. And so that's an expected commitment that you wouldn't have proceeded with the solar project in the first place if you didn't plan to do that. And then there's the credit risk. So it's different from an underwriting for a long-term, exposure on a mortgage or something like that, but it is nonetheless 5 years of risk, both recapture risk and other elements of IRS review, where you can disqualify basis and things. So that's why buyers look to that. One of the elements, this simplifies in some sense the ability to monetize the tax credit with an external investor. But the type of investors that are coming into this, as Erik highlighted, A, don't do solar for a living, and B, still have tax or still have credit sensitivity. So there's an evolution of the buyer base. We have done some transactions advising solar developers and contractors where they buy the tax credit from their own customers. So the nice part about that is you have more familiarity with the seller. So from a credit standpoint, it makes it simpler. You have more familiarity with the project and with solar tax requirements. So you don't need as many things, and you don't layer in as many transactions costs to validate the tax credit amount. So that can accelerate those. But when you're dealing with, arm's length parties with this universe of taxpayers that have been brought into this, they're going to approach it as a financial product with arm's length underwriting and all these other considerations. The market will mature. You will get, for example, rewind 15 years in the solar industry. We had this happening with PPA financing, where at first it was utility scale style partners trying to finance small commercial projects with investment grade clients. And we evolved from there. We found a window for nonprofit entities, houses of worship, and private schools, where we had an investor base that liked that type of credit. So, whatever that type of credit is today, subsets of different industries, as buyers emerge that have comfort with whether it's agriculture, where I'm exposed a lot, or REITs, which I think we'll talk about, or whatever, as you have buyers with fundamental credit comfort, that should better enable smaller project tax credit sellers to do their deals without all of the either underwriting overhead or in some cases just deal risk about inability to get underwritten at all. But it's definitely at a transition stage where buyers are still understanding, and those who will be more aggressive haven't fully stepped into the industry yet. But Erik's closer to a lot of the buy side, so he may have different views on some of that.
Yeah, I mean, I can just to jump onto that. The buyers, I mean, we have a crazy challenge because there's no one specific industry that's our buyer. There's credits of all sizes and corporate taxpayer buyers of all sizes. And while people would like to have a lower effective tax rate due to tax credits, and also would like to pay less cash from a treasury perspective for their tax payments versus discounted tax credit purchases. There's a lot of education that goes into that, and I think that education comes pretty early on with a discussion around risk tolerance and deal involvement and advisor network who they're using, understanding what approvals processes are, what risk or audit processes they have. Thankfully, there's a little bit of a benefit of trickle down understanding. So, we already had a long history of clean energy credits, and the rules around transferring them were pretty formal. And so, big four accounting firms understood this asset class quite well. That helped big four accounting firm clients, Fortune 500 and whatnot, be able to transact with that. And where we saw, this is how far can it go down, and what do those buyers look like in the mid-market? And, if you think about it, a small business that is generating, $10 million of profit is still actually a pretty big business when you think of American businesses, right? $10 million of profit, okay, 21% of that is, $2 million of tax liability. Okay, and then you take three quarters of that because there's a 3/4 max. It's only $1.5 million of credit appetite. And so that turns into a small credit for what you already thought was kind of a big client. And so getting them to get comfortable with this and how this can work for them can take time. And so that risk appetite, understanding what kind of client they want to work with and what kind of protections that they have. And we've come up with products to try to help with that, understanding, hey, if you want a deeper discount, maybe you should only be looking at credits where you're going to rely on the counterparty. What kind of counterparty do you want to have? If you're doing large credits and you are very conservative, maybe you need an investment grade insurance carrier to have a policy onto your credit. And so that can be a little, it can be quite the focus in terms of like identifying what's the right fit for them. But, over time we get there. And that type of buyer sort of risk tolerance, because they do have to sit on this. And many tax directors say, hey, I'm doing this because my CFO has heard about these and they've told me to do this, or I think that this is a good strategy for my company. But, we're buying a, cash benefit of, like I said before, like that, $300,000 for that $1 million credit. I don't want to face, we're only getting $30,000 of benefit. I don't want to face a $300,000 plus interest and penalties hit on my taxing, because that could cost me my job. And imagine that at $10 million or $100 million. There's a lot of eyeballs that go on these things the bigger that you get. And our trick is trying to make sure that the right amount of eyeballs are on it for the medium and small deals.
Yeah.
It would be nice to get, Dan, to the point where we have an investment grade desk and a high yield desk, non-investment grade desk for these kinds of credits.
Yeah.
In some ways we're de facto there, but we're definitely not formally there. But somebody made a lot of money figuring out the market for non-investment grade bonds a few years back. And I think that is, as where Erik highlighted, that's the opportunity here, is where do you fit in the credit versus, pricing metrics here.
Yeah, absolutely. Well, so let's, like, within that, what is the minimum value of tax credits that this even makes sense? Erik, when we were prepping, you shared with me, there's some variable costs and then there's some fixed costs. So there's got to be a bottom floor, if you will, where below this, it really just doesn't make sense. So like, what is that window of opportunity or kind of minimum value of tax credits that we should even be exploring this as a business leader?
Well, I never like to stop people from building renewable energy, so I'm hesitant to answer this question. Any size solar panels is solar panel for me. I would say this is all a question of the buyers and what the advisor group is on this, right? If you have a buyer who says, I'm willing to do a deal for $100,000 of tax credit because that's all we have, and just come back to me when it's ready, you might be able to get that done. If you can get them to understand the risk profile or not worry about the counterparty, you could certainly get that done. We're working with a new manufacturing company that is manufacturing a credit qualifying product. It's not quite ready for prime time, but this is a building accoutrement, if you would. And so this building upgrade that you can do might only cost $50,000 or $100,000 for a building to do it, and they qualify for a tax credit off of that at the 30% rate, or if there's the right geography, could be upgraded. We didn't even go into that, but anyways, call it 30%. So that could be like a $15,000 or $20,000 credit. Now, if you have a buyer who's willing to say, "Hey, just give me this minimum diligence package on each of those," you could do a bunch of those. We're working on how to aggregate those. Generally, where we are in the market right now, and where we're confident, telling buyers, and it's still not always easy, and James knows this because we're on a couple of these together, is we designed a specific product to do in 2025 credits that was for $250,000 to $2.5 million in credits, and that specific product is called Bolt. It's supposed to be this streamlined process. You don't have any buyer's fees. There's a one sort of transaction bundle that Basis is doing that covers an insurance package even at that small credit volume. And that can make sense. The reason we can't go below 250 is because in the first year of this, our insurer said, we want to see what this looks like 20 or 30 times. Don't come at us with 200 credit transactions in the year because that's a lot of paperwork. Let's see how this can go. And then we can talk about reducing the volume. And so, you can, if you're a multi-building owner, you can do multiple $100,000 credit sales, but in 1 year and fit within that box. But that's sort of where we are. There are some other people who can do lower. Always sort of peek behind the curtains of any person who's helping you sell credits and understand what the real buyer's landscape is and expect honesty from that person because we take a lot of time to get those buyers to the table, and sometimes they also end up not being able to finish the transaction. And so this is a transaction business, but the idea is how do you standardize it and keep it going so that you can do smaller and smaller credits.
Nice. Yeah, standardization seems to be able to work your way down that spectrum. James, are you seeing similar as far as kind of the volume of credits that makes sense to transact?
So I'll answer it this way. We have decided to focus on a subset of that, which is generally smaller credits for owner user clients. Now, in some cases, that means portfolios, particularly in California, where the state did some other thing to sort of push a flurry of projects in 2022 and 2023. We're working on a couple of portfolios of agriculture and real estate projects. We have 3 to 10 million of credits per year. And the energy community credit specifically is this kind of straightforward adder to lump in there. So, there's that group. But for the businesses that did a single project or a couple projects, we work with some dairies and manufacturing companies who just did a manufacturing company in Arkansas. Those are, let's see, I'm going to answer probably differently than your initial question, so you can pull me back in. But, those are challenging, and the buyer base for those, we expect, Erik's team is doing some great work for us on one of these in particular, but that's a different buyer base than the corporate buyers who are buying, the 10 million portfolios for us. I think those are going to be largely high net worth buyers. And we may find some crossover where it's a high net worth who has a corporation, but we'll call that more individual as opposed to large corporate. And they bring in a different requirement set. In fact, we did a transaction last year with Erik that was done without tax credit insurance or a letter of credit based on a holistic, comprehensive underwriting understanding, that went great. And I think that kind of highlights that when you have these pockets of investors that have an appetite to do something, they'll find relative value. By cutting transactions costs out, the seller will also find value there. And that's a great combination. That will not be the case for all projects, and those will be supplemented, whether it's personal guarantees or pricing impacts in some cases to get those smaller credit deal done. And conversely, we're working with some clients that have 50 years in business and a $50 million balance sheet. So I just coined the 50-50 club for those kinds of buyers. I think that's a substantial business that a buyer can look at that and say, okay, I can or underwrite that on its own without credit support in the form of guarantees. Those are the businesses that, even though their projects are small, the businesses are substantial, and they should be able to transact without those kinds of credit enhancements.
Okay, nice. I want to ask one quick question, then I do want to make sure that we have some times to get into REITs, because I know we hit on that briefly. But as a someone that's looking to build one of these energy systems and determine whether or not tax credit transfers belongs in my financial strategy, do I need to like know this on the front end before I sign an EPC agreement to build one of these systems? Or is this something, maybe I've already signed an EPC agreement 6 months ago and I'm down the path, and now I was planning on doing retiring the tax credits myself or utilizing the tax credits myself, but now I want to consider this. Is that still an option for me? And Erik, maybe I'm looking at you.
Yeah, I talked earlier on the timing of the tax credits and when you need to get them in the filing. So I think this answers your question. So, if you build a tax credit in January of 2026, last month, and you build a project, it was placed in service. There's a tax definition of that, but generally it's operating fully. Your grid operator let you turn on, and you're pumping solar rays into electricity on an uninterrupted basis, and you've got all your permits. So that credit has been generated. Technically, you can sell that credit all the way until you file your extended filings in the subsequent year for that year. So if you're a calendar year tax filer, your fiscal year ends on December 31st, you would file, if you're a partnership, your taxes normally in April or May, and then you actually have 6 months of extended filing dates. And most people choose to extend their filings until September, October of 2027 at that point. And that's a long time to be holding onto a credit you want to sell, but it's also a lot of time for flexibility if things change and you're like, oh, I would like to sell that credit. So the number one thing that I say is, if you generate a credit, do not file your taxes on time. Request an extension, pay your estimated taxes that you have to file, do all that stuff, but do not file on time, because you're cutting out a very important, especially at the small end of the market, 6 months there. James mentioned high net worth individuals. A lot of high net worth individuals are playing the kind of optimization game. There's a really complicated rule for which of their taxable income qualifies to buy clean energy credit, because they didn't want this to be a TurboTax button you could click, because that's a lot more of government revenues that could be utilized for tax credits, and that would have been nice for us to do that, but it's not there. So the passive income requirements for high net worth individuals often means that they come into the market quite late. And that quite late in the market could mean that they're coming to players like ourselves or directly to James saying, we're looking for a $500,000 credit from last year. It doesn't matter when, and it might be May or June of the subsequent calendar year. And so long as the seller hasn't filed their taxes, not having transferred the credit, then you're in good hands to be able to transfer it in time for September.
That's great. Super helpful.
Erik, in our experience with you specifically, there is a premium on high net worths that have more flexibility, especially around later in the tax year execution. We've seen corporates unapologetically go dark at the end of August. 6 weeks seems like a long time, but you can also imagine in a big company chain, that's not a lot of time to solidify your tax filing or decide you're full or it's too complicated or whatever it is. And so there's this kind of less talked about kind of window of execution opportunity especially if you had a project that was completed late in one tax year. We're in February, the market's, waking up. We're working on transactions, but a large buyer base is still closing out the year and doing whatever, accounting other things, and just not focused yet. And then as you get closer to October 15th, you have folks that decide they've got enough or they don't have time or whatever else. So it is important to understand some of those non-obvious considerations about when you can start a process and when you need to be prepared to execute, so you're not facing back end just clock timeout risk.
Yeah, super, super helpful. All right, shifting gears a bit, I do want to make sure that we have a moment to touch on REITs because of their unique tax status or not being taxed, their tax exempt status. How should they be thinking about selling tax credits if they've got on balance sheet systems that they're looking to pursue? Eric, maybe you can share some thoughts first.
Yeah, certainly. We've done a couple of deals with REITs. We're working on our second one right now, just this small individual one, and we've done larger ones as well where they have multiple sites. So REITs generally, because of the way they're structured from a tax perspective, they're basically what is, in simple terms, pass-through entities all the way up until they're investors. And so because of that, there's no one direct taxpayer. So a lot of times, to have, if you're a single REIT investing in your own projects, you might have a taxable REIT subsidiary, which is a special business entity that needs to make a couple of elections, but that would be the tax credit transferor. Some REITs might have this go all the way up to the REIT topco, that is the tax seller, the credit seller, and then that is the selling entity, and that needs to be who sells the credits. In some cases, REITs are actually very healthy financially and are willing to put a guarantee behind that and avoid that whole insurance. And so there's a famous quote in our company of, a REIT that had a few $1 billion in assets, and they were just trying to sell, $2 or $3 million worth of credits through us to justify sustainable buildings. And they said, this is great, but why is this taking so much? I spend less energy buying a $1 billion building than developing or selling this tax credit. And we said, there's a lot of complications here, but your name on this deal helps us get it done. Some REITs are not in that position and they're not willing to provide any structures, or maybe there's a couple of different REIT investors that are doing a joint venture investment. We're in a case like that. And they might say, we can't give any guarantees behind this operating building entity, but they're just a bunch of multifamily rental units. So what does that really mean for a tax credit buyer? In which case, putting a tax insurance wrap on that might make sense.
Okay, super helpful. James, I know you've got quite a bit of experience working with REITs as well. What are you seeing in these types of transactions?
We have a lot of experience talking to REITs about these transactions. We also have a lot of experience with REITs not deciding to pursue solar transactions or not deciding to pursue tax credit sales as part of those transactions. Mm-hmm. And the primary reason for that has been, it's probably a combination of the factors of credit and subsidiaries, but ultimately the idea of taking on indemnities for 5 or more years, institutionally, REITs don't seem to have the appetite for that. Now, in some cases, that's because you fully expect, and it's part of your mandate, to reposition properties regularly, and you don't want an indemnity, even relatively small compared to the value of the property, to be a consideration if you're going to enter into one of those transactions. You may have issues with providing indemnities or guarantees for partnerships, particularly if you're managing partnerships that are not wholly owned. But barring those two factors, if I have a creditworthy REIT with a long-term hold view on a partnership, that's a great candidate for this. I will highlight that there are what I'll just call alternate structures that are not tax credit transfer per se, where through third-party ownership, where the tax credit can be monetized. Those have the sort of trade-off of more flexible from a credit and asset transfer basis for a REIT that fully intends to transfer the property, and less attractive on an overall pricing basis. So as you would expect. And these structures with third-party ownership predate the tax credit transfer legislation. There's been a lot of finance going on in solar with tax credits for 20 years. And so there are options there. But when talking, the other thing we've seen in the market is, and this wasn't limited to REITs, but I'd say it was enhanced at the REIT discussion level, is the size, pricing, and just transaction simplicity on projects was probably overly optimistic in the early days. So the smaller the number of projects, and in some cases, as people have talked about taking things in basis, that may be more aggressive. I'd say the most straightforward way to do it is sort of hard dollar cost, construction value with no related party developer fees. Those are, and we're still in conversations with, to be fair, more than one REIT that are good candidates for this, and whether we'll advise them or what direction they'll go is to be determined. But there's still a good opportunity, and I just say those are early stage conversations we have with particularly our REIT clients to understand: can you sign off on the indemnities, and can you properly guarantee or have them underwritten?
Yeah, absolutely. And I could see that being a sticking point, but others maybe not so much, where they're long-term holders of these of their properties, and so that becomes less of an issue. James, this has been great. Really appreciate your time. Where can our listeners find you if they have additional questions?
Conductor.solar is our website. Again, we're a marketplace, technology-enabled marketplace and project finance advisor for tax credit transfer and other forms of tax credit and solar and battery financing.
This has been awesome. Erik, really appreciate your time and your insights and for sharing with our listeners. Where can our listeners find you?
Yeah, so we have a catchy website name, so listen to it. It's buildwithbasis.com. We hope that you build your clean energy tax credits with Basis. And, we have a special program that you can find on our site for smaller credit sales called Bolt. And that is an insured sort of conveyor belt type tax credit selling process. And we're excited to, work with new people. And if you have any questions, we're here to answer them.
Wonderful. Thank you so much, Erik.
Great talking with you and great working with Erik. Nice to see you guys.
Take care. Thanks, James.
Thanks, David.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.